Despite the negative news circulating about China, it's clear that their economy is holding steady and even growing. For instance, in the first 3 months of this year, China's GDP increased by 5.3% compared to the previous year, surpassing expectations.
The economy growing faster than expected in the first 3 months of this year, thanks mainly to a strong investment in high-tech manufacturing. Our GDP in the first quarter climbed 5.3%, picking up slightly from the previous quarter and beating estimates.
So what happened to the idea that China's economy was on the brink of collapse? In this video, we'll delve into why China's economy remains robust. Using data and facts, we'll explain how China effectively manages its economy. Despite challenges like the property market, China continues to bounce back and make significant contributions to the global economy. Don't forget to subscribe to our channel for more engaging content. Let's explore why China's economy is still going strong. Is China's economy about to collapse? Over the past 30 years, China has seen impressive economic growth, moving from a low-income to an upper-middle-income status. Following economic reforms, China consistently achieved an average GDP growth rate of over 10% annually for more than 3 decades, with some years even surpassing 13% growth. Despite this success, critics have long predicted China's economic downfall, citing various vulnerabilities. The country's growth heavily relied on investments in physical assets, particularly real estate, which were often funded through an inefficient banking system. With mounting domestic debt, a turbulent property market, and a shrinking labor force, some analysts warned of an impending crisis. The aftermath of the pandemic and subsequent lockdowns led to a slowdown in China's economy. In 2022, GDP growth dropped to 3%, triggering alarms among Western experts who predicted China's collapse. Interestingly, during the same period, the United States experienced modest growth at 1.9%, yet there were no talks of a U.S. collapse. This disparity raises questions about the singling out of China for economic concerns. In 2023, China's GDP growth rebounded to 5.2%, surpassing expectations. However, despite this positive trend, critics continued to argue that China's economic collapse was inevitable simply because its growth rates were no longer in double digits. Fast forward to the present, China's economy has once again defied expectations by growing 5.3% in the first quarter of 2024. How did China achieve this feat amidst challenges in the property sector and an aging population? Let's delve into the answers. China's property bubble. The Chinese economy has grappled with significant challenges, especially within the real estate sector. Statistics reveal that the real estate industry contributes roughly 25% to China's total GDP. However, unlike other sectors that have largely returned to pre-pandemic growth levels, the real estate sector has lagged behind. Since 2022, it has been a detractor from China's overall economic growth, playing a role in the recent economic slowdown. Despite being a major drag on the economy, there are signs that the real estate sector's troubles might be easing. Its negative impact on GDP growth reduced from about 4% in 2022 to less than 2% in 2023. Additionally, China maintains relatively high interest rates, with prevailing lending rates hovering around 4.5%. This results in a higher real interest rate, calculated by subtracting inflation from the nominal interest rate, compared to the United States and significantly higher than in Europe or Japan. Furthermore, China's cash reserve ratio, which dictates the percentage of deposits banks must keep with the central bank, stands at 10% for large banks, contrasting sharply with Western countries where this ratio is close to 0. Given these factors, China has more flexibility in its monetary policy. It can potentially ease its policies by reducing interest rates, adjusting the cash reserve ratio, or employing a combination of both, options not readily available to other major economies. Economic transformation. While the real estate sector in China is indeed experiencing a slowdown, the impact on the banking system or the broader economy is expected to be limited. Given that the real estate industry has been a negative contributor to China's overall growth, the question arises about what sectors will drive economic expansion moving forward. An insightful study from 2022 indicates that the green economy and the digital economy collectively added 4.7% to China's growth rate, effectively counterbalancing the 3.7% negative contribution from the real estate sector. China's leadership position in industries associated with the fourth industrial revolution, such as green energy, digitalization, industrial robotics, and artificial intelligence, is noteworthy. For instance, China has recently surpassed Japan as the world's largest exporter of cars, a significant proportion of which are electric vehicles. Moreover, China has achieved remarkable growth in the production of lithium batteries, vital for electric vehicles, mobile phones, and various other sectors, increasing its global market share from 0 in 2005 to an impressive 63% today. Similar growth trajectories can be observed in wind power and industrial robot installations. This forward-looking approach is underscored by Premier Li Qiang's announcement to expedite the development of solar panel farms, wind energy projects, and hydroelectric ventures. These initiatives align with China's strategic shift toward renewable energy and emerging technologies, signaling a departure from traditional sectors like clothing, furniture, and appliances. The emphasis on sectors such as solar power, electric vehicles, and lithium batteries reflects China's strategic vision to revitalize its economy through high-tech manufacturing and sustainable practices. This strategic realignment aims to mitigate the impact of the housing construction sector's slowdown and propel China toward a transition from low-end production to cutting-edge industries, driving long-term economic growth and sustainability. China's population challenge. Indeed, China's aging population is a topic of concern, but it's important to note that this demographic shift doesn't necessarily equate to a decline in the workforce. Here are some detailed explanations to support this view. Firstly, despite China's labor force peaking in 2012, its GDP has more than doubled since then. This indicates that the productivity and efficiency of the workforce have increased significantly, offsetting any potential decline in numbers. Secondly, China maintains relatively low mandatory retirement ages, set at 60 for men, 55 for female civil servants, and 50 for female workers. By raising the retirement age, China could effectively expand its workforce and tap into the experience and skills of older workers. Thirdly, China's urbanization rate stands at 65%, which is lower compared to highly urbanized countries like Japan, 91%, and the United States, 83%. This suggests that there is still room for migration from rural to urban areas, potentially bolstering the workforce. Moreover, China leads globally in industrial automation, with 50% of the world's industrial robots installed within its borders. This automation trend reduces reliance on manual labor and boosts productivity, mitigating the impact of demographic changes on labor availability. Considering these factors, it's unlikely that China will face a significant labor shortage due to demographics in the near future. In fact, there's potential for China's labor force to be underutilized, indicating a balance between demographic challenges and technological advancements in sustaining the workforce. So, do you agree with our video? This is why China's economy isn't collapsing anytime soon. Share your thoughts and leave your comments below. If you like this video, hit the like button to show your support. More importantly, subscribe to our channel so that you will continue to receive more interesting videos just like this one.